Good morning and welcome everyone to Money Control live stream. You're watching the opening bell and I'm your host Nickey Mirchandani. Indian Equities set for a tepid start after previous session recovery that we've seen. Nifty indicates somewhat cautious start coming in for Indian equity markets. Trades around the 21,700 mark. Talk about the global handover. US market ended in lower overnight amidst a sell-off in technology stocks and a spike in treasury yields. Well, signals from the labor market weigh on the US rate cut expectations, and Asian markets at this point of time trade mixed amidst tracking overnight losses on Wall Street. Key economic data aid. Well, F&O cues that you'd like to watch out for. FIIs have been the net buyers in index futures and bank Nifty futures. Along with that, they've been the sellers in index options. Do bear in mind the fact that it was also the expiry day, and have been sellers in stock futures. In terms of F&O ban, what comes in the ban is Chambal Fertilizers, Escorts, GNFC, India Cements, and what still remains in the ban is Balrampur Chini, Delta Corp, Hindustan Copper, IEX, National Aluminium Company, SAIL, and Z Limited. Nifty PCR, perhaps more puts being written as compared to that of calls, 1.22 versus 0.76. But let's get going with the strategies, levels, and the top recommendation of the day with Kush Bohra from kushbohra.com. Morning there. All right, Kush.
Hey, morning.
Hi. Let's start off with checking with you assessment of what are we really looking at for the day. Yesterday, it looked like more of a short covering activity, or you think it's trend reversal of sorts at play?
Hi, Nickey. First of all, very good morning to you and all the viewers. Interesting, we start with that question because, it's in a bit of a limbo. See, yesterday was a very good move on the indices, and, the kind of put additions that we've seen suggests that the support bases have rather increased. But it's too early to call it out of the woods or, a kind of trend reversal. One reason being historically, we know January has been a bit of a tepid month, but not before it crosses the December highs. So I won't be surprised that over the next couple of sessions, let's say, the markets tend to hit new highs. But even then, I would probably be, optimistic, but a little cautiously. And let's take every day as it comes, because right now the situation or the setup is such that it doesn't really inspire confidence on either sides. So 22,000, 22,200 on the upside and 21,300 on the downside are the broad zones that we're looking at, beyond which we could perhaps say that there's a confirmation of the trend. Within that, since the VIX is already a bit high, we could see bouts of volatility coming in.
All right, immediate support and resistance level for Nifty and Bank Nifty, and also the strategy for the day.
Sure. 21,500 and 21,900 are the near-term levels for the Nifty. For Bank Nifty, 47,700 and 48,600 are the levels for Bank Nifty. Right now, the kind of moves that we've seen, and as I said, the kind of support zones that we've seen shift up, given the put bases, increase at, closer, contracts. It's a good idea to be a buyer, preferably on dips. So that's the strategy that I would have on Nifty and Bank Nifty both. As far as stock-specific action goes, both of them are breakout candidates. L&T Finance, after a couple of days of consolidation, has seen a volume-backed breakout. 165, 170 was a resistance zone. It's able to take out that. Now 176 and 180 are the two levels that we're looking at on the upside, and 168 will act as a support zone. Jyoti Labs, very similar structure. It was knocking on the doors of this 470, 480 kind of levels for the last couple of sessions. Yesterday, it's been able to take that out very convincingly. From here on, 514 rather, and 525 are the targets that we're looking at, and 492 is where I would now place my stop loss.
All right, point well taken. I'm going to come back to you in just a bit. I'm going to address in stocks and news first, because there are few things that I'd want to highlight before the opening bell. Of course, Kush, I'm going to come back to you in just a jiffy. The first stock that I'd want to address is Grasim Industries, where the board has given an approval for the right issue to an extent of 3,999 crore or thereabouts. The company has overall set in an issue price of around 1,812 per share, and the right issue is going to be starting in from Jan 17 to Jan 19. The record date has been set as of Jan 10. Entitlement ratio, of course, has been set in the right. 6 rights to be issued, right equity shares to be issued for every 179 equity share held. So that's the one that I'd want to highlight. Of course, Dabur, that's another one which I'd want to talk about, where there is an update which has come through in terms of the Q3 numbers. The consolidated revenue per se is expected to be in the mid to high single digit per se. And this is essentially driven by the consumption. Well, essentially by the improvement overall in the demand trends put together. There are early signs of consumptions also which are visible with improving trend. And if you look at the segment-wise breakup, F&B business India is expected to grow in high single digits, and home and personal care is expected to record in mid single digit growth. International business is expected to report in a double digit growth, at least in constant currency basis thereabout. If you look at what Morgan Stanley has to say about Dabur, it's said that it's a weak Q3 which continues to lag in the rural sector demand, which remains weak for sixth consecutive quarter. So that's the pain point again, which is pending for Dabur. You know, we've not seen much of revival coming through for the rural demand, and that's also one factor that could weigh in on the performance. But otherwise, the double-digit performance is expected to be a good highlight coming in for Dabur. But a very interesting report has come in overall on HAL, along with that CG Power. Now UBS has initiated coverage on both of these stocks. So of course, these are going to be the stocks that we're going to be clearly eyeing. But Nifty 50, 0.3% of gains coming in for Nifty 50 index. 21,700 mark is what we were looking at and what we've got. Bank Nifty, let's look that up just to see if there is a fair bit of outperformance which has come through. Well, significant amount of gains clocked in early deals. Let's also talk about the top gainers and the top losers of the day before we navigate our conversation back to Kush. Well, top gainers in terms of Nifty 50 index. NTPC, that's an interesting one. There was an initiation report yesterday on by Axis Securities on NTPC, Bharti Airtel Coal India. These are some of the other top gainers that we have overall on the list. Apart from that, we are also looking at some other gainers just to pull that list up for you. That's the one that we need to watch out for. Hero MotoCorp, BPCL and Bajaj Auto. These are some of the other top gainers. Hindalco, Wipro and Power Grid. Of course, it's also going to be a bunch of IT stocks which are also at play. Along with that, Hindalco is also the one that we need to watch out for. But NTPC was an interesting one. Let's look at losers now. Nestle India, IndusInd Bank, Axis Bank. Well, it's a bunch of financials out there, along with Asian Paints and Britannia. Well, Kush, coming back to you, NTPC, does that look interesting?
It does, and what's encouraging is the fact that the stock, with the kind of sharp run up that we had seen over the last couple of months, had actually gone into severely overbought territories. But over the last few sessions, it's cooled off. We've seen cooling off in terms of not just the price action, but also the momentum indicators, which is suggesting that the stock is now ready for the next leg of up move. And we've seen that yesterday, the stock gave a very clear breakout above its previous highs of 315. Now, again, there's a very strong follow through. I think 340 is, a very convincing near-term target for NTPC. And on the downside, 315, which I said was a resistance zone, will now start to act as a support zone and a stop loss. So again, as I said, the stock's ready for the next leg of up move from here on.
Kush, it clearly looks like, we are looking at a reversal of trends coming in for the markets. But is it too early to just say that as yet? Would you want to wait it out for an hour, hour and a half, just to see the momentum of the markets? How are you looking at it?
No, absolutely. The view remains the same, which is cautiously optimistic. The put bases have increased, so that does warrant some sort of a confidence in the move that we saw yesterday, and we are seeing the follow through today as well. It's just that there could be a Friday effect also playing out on the indices. Plus, we're very close to all-time highs on both the Nifty and the Bank Nifty. Perhaps a bit of profit booking will not be a bad idea. So, as I said, the strategy would still remain the same, which is buy on dips. Any dip from here on the index, on Nifty rather, of about, let's say, 50 points odd, and on the Bank Nifty similar, if it gets a little flattish, then it's perhaps a good time to, enter again. That will be a favorable risk reward ratio.
Okay. Also, I'd want to chat about HAL. There is an initiation report by UBS. It's initiated coverage with a buy rating target price of 3,600. Talks about the company perhaps now setting in, or let's just say tripling its order book believes that the company is on course to re-rate by a similar magnitude to BHEL in the past decade. It's talked about sharpened policy focus to compress a $60 billion opportunity into 5 to 7 years, and also spoken about the revenue CAGR at 16%. Kush, coming on this one, what do you make out of something like an HAL? It says that it's going to be a next BHEL.
What's interesting is the fact that the kind of rally that we've seen in these stocks over the last couple of years now, there would still be some naysayers. Now this report sort of belies that, and the fact that if there are some pockets in the market which still believe that either the rally is overdone or perhaps just done, it'll just push the stock that much higher, right? From my perspective, there is still a lot of steam in the entire PSE pack, be it banks, be it railway names, be it defense names. So a lot of these names will still continue to do well, and HAL, as it has been over the last couple of years, will continue to be one of the leaders of the pack. 3000 is more of a technical resistance. We're also seeing some call base there, as is typically the case, but I don't think it will prove to be a major hurdle. In the near term, I would suggest, if anyone wants to take a fresh entry, 3130 and then 3200 are the targets that one could have in mind positionally, and then on the downside, a very clear stop loss at 2930.
All right, Kush, we're just going to leave it at that. And thank you so much for taking out the time and having this conversation with us today.
Bye.
All right, there's also an initiation report of UBS on CG Power. Target price is at 580. And it talks about the execution now being solid by the leadership team, which should drive industry-leading returns for the company. On back of that, you're seeing a good uptick coming in for both CG Power as well as HAL. They've been up and about with gains to an extent of 3% But of course, we are here to talk more about the fundamental side of the story. And we have a very special guest with us. Remember, it's a Friday special. Harsha Upadhyaya, the Chief Investment Officer at Kotak Mutual Fund, joins us this morning. Morning there, Harsha.
Good morning.
All right, I'm going to start off by asking you about the trend that you're drawing in at the start of the year. Of course, it's been a bit of a cautious start coming in for the markets, at least for the last 2 or 3 odd sessions that we've seen. But overall, if you look at the trend playing out for markets 2023, 8th consecutive year of gains, FII trend seems to be reversing in the favor. What are you picking up and what are your wall of worries?
See, clearly from a fundamental perspective, I think things are in place and there is not much of a worry in terms of either the macroeconomic fundamentals or in terms of corporate fundamentals playing out as expected by the markets. However, what needs to be kept in mind in 2024 is we are entering this market in a phase where it has already given substantial returns over the past 1 year as well as past 3 years. And these returns seem to be much higher than the trend line returns that we have got in the past. So to that extent, valuations have definitely moved up. So one needs to be cautious of the valuations and accordingly place their bets. For a medium to long-term investor, we still believe that things are still fine.
All right. Any particular bets that you think look little interesting at this point of time, especially in the run-up to budget? Defense, power, PSU themes, what's exactly that you're looking at?
Usually at Kotak Mutual Fund, we do not bet on events because there is no way to predict some of these events. But very clearly, I think there are various areas where the government focus will continue to be there. For example, the ones that you mentioned, defense, railways, infrastructure, etc. These are the themes which will play out for the next several years. It's not that just because of one calendar year or one financial year, some of these themes will run out of steam. So to that extent, yes, we do believe that capex beneficiaries or beneficiaries from inadequate infrastructure development that has happened in the country and where government is refocusing. These are some of the areas which will continue to gain focus and which will continue to offer medium to long-term growth. However, as I mentioned earlier as well, there are many pockets in the market which are quite expensive at this point of time. So to that extent, one should not just go by the growth characteristics, but also keep valuations in mind. So wherever you find relatively safer opportunities, that's the way to build a portfolio.
Sure, Harsha. I'm going to chat with you about the interesting themes in just a jiffy. But before that, I'd like to know Does it look like there is very little value in the market across the capitalization spectrum after the recent run-up that we've seen in mega cap names, and the last bastion of value in the market until recently, that's the mid cap and the small cap also? Do you kind of see that even large caps at this point of time seem to be a little, trading a bit higher as compared to the historical averages?
Yes, clearly, even the large cap index is now trading at a valuation which is more than the historical average valuation. So, to that extent, yes, there may not be easy money that is going to be made in the near term. As far as mid and small caps are concerned, clearly the valuation comfort is a lot lesser. As you go down the market cap curve, as you go down the liquidity curve, there seems to be a lot of richness in terms of valuations. And many of these pockets are not necessarily driven by just fundamentals. They're also driven by how money flow has been in the recent times. So to that extent, obviously the cautiousness increases as you go down the market capitalization curve.
Harsha, are you moderating your return expectation, or you think investor rather should moderate their return expectation as compared to what they've seen in the previous year? Of course, it's also the year which is marked by the interim budget and general election per se, essentially. Which are the factors that you think can otherwise reverse the market momentum thus far that we've seen?
See, clearly, I think there is merit in moderating expectations on returns because what we have seen on especially mid and small caps over the last 1 year or over the last 3 years from the COVID bottom is unlikely to get repeated every year, every 3-year block. The kind of returns that you have seen where mid and small caps have outperformed large caps by about 20% in the last 1 year. And even when you look at the CAGR returns over the last few years, that's been the kind of returns that they have made over large caps. So I think that's unlikely to be sustainable. So on a base case, one should be looking at more moderate returns, more in line with earnings growth, and also with a lot higher volatility as compared to what we have seen in the last 1 year. Markets are never one-way street. They may have behaved like that in the past couple of months or couple of quarters, but unlikely to remain that way. And as you go higher on valuations, there can be any risk, internal or external to the economy, which can come and derail the momentum at any point of time. So to that extent, one should be ready for more volatility in the markets. More volatility does not mean that you will not make returns. You will make returns, but maybe more moderated level of returns as compared to what has been seen in the past couple of years.
Sure. Harsha, I'd also want to chat with you about the themes per se. And when I say themes, to be more focused, it's going to be HAL. Essentially, there is an initiation report also which has come in by UBS talking about the company perhaps being the next big thing over the last given the kind of rating triggers, given the kind of developments. It talks about tripling of order book. How bullish are you overall on the defense theme and also the power theme specifically? The reason I ask you is, in the run-up to the budget, do you see some amount of perhaps a momentum building up within these two themes?
As I mentioned earlier as well, we do not bet on any of the events. So rather than that, we analyze fundamentals and valuations and keep looking at it from a more medium to long-term perspective. When we do that on defense or power, clearly the runway for growth seems to be quite large. As far as power sector is concerned, I think the demand-supply mismatch continues to be in favor of power producers. So to that extent, I think power prices will remain strong, and also there is going to be enough momentum on the power capex side, which will again benefit many of the other ancillary companies as well, along with the capital goods and engineering companies. As far as defense is concerned, there is a clear focus by the government to increase indigenization levels in the defense sector, and also in terms of the growth opportunities, not just the domestic market, but the exports market is also something which is looking very attractive at this point of time. Given that there are many conflicts going on, I think there will be more and more requirement of ammunitions and defense equipments, and India can capture this opportunity from an exports perspective as well. So definitely from a 3 to 5 year theme, these two definitely look good. However, as I said, every pocket of our economy, not just defense and power, many others as well, have re-rated quite substantially over the last couple of years. So to that extent, one should be mindful of the valuations and the volatility that could come in at higher valuations.
Harsha, any more themes that you'd like to talk about, which essentially you're looking at closely from a medium to long-term perspective, not of course just the immediate trigger of budget, but overall drawn out for the entire year? Apart from that, I'd also want to chat about real estate sector because that seems to be in a bull run of sorts, at least a super cycle of sorts. The last year has been rather encouraging for real estate index. What do you make out of it and the sectors and themes that you think one needs to watch out for?
We have already spoken about a couple of things. For example, capital expenditure beneficiaries, when investment cycle is turning up, entire space is likely to do well. And also the areas where there was inadequate focus by the government in the past, and now we seem to be getting a lot more renewed focus on defense, railways, infrastructure, etc. So those are the other segments where one can look at investing. Apart from these two themes, clearly the financial services sector remains to be one of the key areas. It may not have performed so well in the recent times, but if our economy has to grow at a pace of, let's say, 6.5-7% on a nominal basis of 10% plus, definitely financial services will have to grow. And whether you look at the lending side or the non-lending side, the penetration levels have been very, very low, and there is a long runway for growth in that segment. And as far as lending side is concerned, we are unlikely to see any asset quality issues anytime soon because we are at a nascent stage of a new cycle. So overall, this segment looks much better from a valuation perspective, and also from a medium-term outlook perspective, it looks quite good.
All right, one final question that I'd want to squeeze in here is perhaps check with you about what you anticipate the earning growth to be like in FY24 and 25. Of course, the EPS upgrade for the current financial years were driven by OMC in FY24 at least. What do you make out of the earning growth profile for this year, by the end of this year and the next year?
We are expecting about 17 to 18% CAGR earnings growth on the Nifty basket for financial year 24 and financial year 25. Yes, the first half has already played out. It has been much better than what the full year numbers have been. We have seen about a 25% earnings growth for the Nifty basket during first half of financial year 24. But we do believe that second half is going to be slightly more moderated, especially given that the base effect will come into play, and it may not be such a favorable base as compared to the first half. But still, for the financial year 24, we expect Nifty earnings to grow at close to 20% or so. And next year, probably it will moderate a little downwards and be in the mid-teens. Overall, I think these are healthy growth numbers that the market is expecting. So give or take a few percentage points, if these numbers are achieved, I think markets can sustain these valuations, albeit a little bit of more volatility, I would say.
Harsha, one final question where, talking about the large cap space, most of the sectors at least seem to be trading at a premium as compared to the historical average. Talk about auto, the commodity chemicals, the construction materials, consumer staples. Which of the sector within the Nifty 50 index per se that you think are still trading at a discount and look like a valuable proposition at this time?
Hardly any pocket which is at very, very attractive levels, as the overall market itself is a fair zone or a fair zone plus kind of levels in terms of valuations. But within that, I would say large cap banks and maybe a few stocks in the pharma sector are the ones which offer a little bit of a downside support because of the valuations and also because of not so high institutional ownership that has got created in the recent times, which means that in times of volatility, there may not be too much of institutional selling in these baskets. Overall, yes, these are the two pockets where relatively there is a little bit of more valuation.
All right, Harsha. So banks and pharma is what we can look at. Harsha, thank you so much for taking out the time and having this conversation with us. Indeed, a pleasure. Right, now let's navigate to the interesting segment of the show, and we're going to be talking about, or let's just say drawing in the key trends related to the IPO market, related to the block deal transaction, the hottest sector, and the transaction that you need to watch out for in 2024. And to take us through all of that more, we're here joined by Ashwin Mohan, the Senior Editor M&A at moneycontrol.com. Morning there, and thank you so much for taking out the time and having this conversation here.
Morning, Nickey. So, we are fascinatingly poised as far as 2024 is concerned. If you look at the kind of explosive action that happened in the second half of last year, at least in the IPO as well as in the block space, it was the Mankind Pharma IPO which perhaps was the trigger for the flurry of activity in the equity capital market deal space. So, if you look at some of the key sectors and if you look at some of the key trends in terms of sizes, at least, let's keep one thing in mind that last year may have seen quite a number of IPOs, but many of them were in the small cap and in the mid cap space. So that's one thing that was noticed, and clearly the issuers were also very, very careful and conservative when it came to pricing of IPOs. That's another interesting aspect that came about. Because at the end of the day, they wanted the valuations not to be exorbitant. In the past, some issuers have in fact suffered on that count. Now, Nickey, if you were to look at 2024, last year, as we are all aware, was a big one in terms of block deals, right? So if you look at the entire block deal space, never before perhaps have we seen so many big ticket exits by private equity players who are cleaning out their entire stake, 20, 25, 27% at one go.
Yeah.
Now, that wasn't the case earlier, right? And that just goes to show how deep the Indian markets currently are. It's also an interesting trend because what that means is rather than the usual M&A that they would do, they are now looking at a series of block deals or one big one to exit. Case in point being Blackstone, which exited Embassy Office Parks REIT. You also had a big private equity player, Coforge. Coforge, you had Bearings exiting it. These are all big, nearly $1 billion plus deals, right? So that's something that deal makers are telling me is a trend that is likely to continue in 2024 as well. So there will be no stopping as far as the momentum is concerned. Surprise, surprise, even though this is going to be the election year, they are saying that they expect filings by IPO aspirants even right in the middle of the election season, perhaps even closer to the results. That's also something that we haven't seen earlier, right? In the past, we have seen issuers taking a pause, being in wait and watch mode, waiting for which way the wind turns as far as elections are concerned. But no, that's not going to be a factor. That's the level of optimism, at least on the back of the victory of the BJP in the recent state elections. And that's also given investors a lot of confidence in terms of stability. As far as sectors are concerned, Nickey, last year.
Just to interrupt you there, Ashwin, this seems like a trait of bull run.
Yeah,
ahead of the budget and ahead of the general election, you still see a lot of IPOs that are lined up, almost 60,000 crore of around 57 companies. But Ashwin, are they more from the large space because large cap names now? Because we've seen small sizes coming in, like you suggested, in terms of the mid cap names and the SME segment also. How can one now look at what are the prominent names per se that one can look at within the IPO primary markets? Because retail investors typically are really interested within that category.
That's right. So clearly one trend that can be expected is that the size of the IPOs this year is going to be substantially bigger than last year. So if last year the IPOs were about small cap and mid cap, this year you will see bigger IPOs, 4,000 crores, 5,000 crores, nearly $1 billion, right? You will also see participation from a lot of the bigger conglomerates, right? There are a lot of diversified conglomerates that have certain units looking at listing on the stock exchanges. Last year, in fact, was very interesting. You had the first IPO from the Tata Group after TCS, right? You had Tata Technologies.
Right.
We're all aware of the fantastic bumper debut it had. You also had JSW Infra. Now, that also was an IPO from the JSW house after several years. So expect more of that in 2024, bigger size IPOs.
Do you want to throw in some names there?
Let's just wait and watch to see how the filings progress. After the filings, of course, we can definitely talk about these listings a bit more. But very quickly, what are the big sectors, right? Financial services, Nickey, that's one big sector. Consumer, healthcare, pharma, right? These are some of the sectors that they are expecting big IPO filings, and also tech. Keep in mind, startups. Last year, we all spoke about the entire funding winter, right? You hardly had any unicorns. Otherwise, in previous years, you had a unicorn almost every week, right? This year is going to be interesting. You have the first EV company, Ola Electric.
Absolutely.
You have First Cry. So a lot of startup candidates as well. as far as the IPO market is concerned. But one thing is very, very sure, investors are clear. If you're a startup, they will go for startups that are demonstrating a proper path to profitability or have already demonstrated profitable growth. That's very clear. So that's going to be the big differentiating factor, Nickey. As far as block deals are concerned, you know, block deals are what sort of, we had block deals almost in almost every other week. This perhaps was the busiest December in a long, long time. Last year, 1/4 of all the block deals, and that's very interesting data, came from the financial services space. So expect a lot of block deals this year as well. And the same trend. There are a lot of private equity players with chunky stakes in listed companies. Expect them to continue that. So in a nutshell, the momentum as far as IPOs and block deals are concerned is in fact likely to continue, Nickey. And we at Money Control will get you all the latest breaking news as far as the IPOs and block deal scenario is concerned, of course, in the days to come. Back to you, Nickey.
All right, that's clearly the trend that we've drawn in for block deal, the transaction, the space, IPO and more. But with this, it's a wrap and goodbye from myself, Ashwin and entire team who puts this piece together. Thank you so much for watching. Please do post your feedback for us in the comment section below. Follow us on the link at the bottom of your screen. And for rest of the page, stay tuned into moneycontrol.com and Money Control app.